earlier today in the first session. As I say, you need to download those various bits from the ACCA website, and you must have a hard copy, a paper copy, so you can write on it like you do in the exam. So I am, for the rest of today, considering the big 20 markers, plus incidentally some MCQ type material, which shall we say, questions from what out of the big questions we're doing today, we might get little MCQ type questions. Though I'll be doing the more MCQs more formally when I see you on session 3. All right, so the consolidated P&L, we are partway through the question. I need to finish it off and then do that massive published accounts question beyond that from the specimen paper. There is a mock exam available for completion, revision mock. Please send it to me. I'll mark it myself, but send it through the college, obviously, so they can keep control of how many scripts are arriving. And then when I see you next Monday, I'll be doing MCQs for the whole session. And indeed, when I see you in the second session of the day, I'll still be doing MCQs, but we will keep time to do a nice big ratios and interpretation question in the context of consolidations. Okay, so that's the plan. As I say, if you can download all that, that'd be marvelous. The other thing I must not forget to say is the mentoring session from 5:30 to 6:30 UK time will be done by me, of course, but in my typing late at night, I said Tuesday. What I meant, of course, was Friday, the 26th. Okay, my apologies for my bad typing. Right, so where are we? To link up to where we were earlier today and where we need to go, we need to finish off this question called Peneketh and then have a look at Kandy. So where's my Peneketh question? In the revision kit, I've tried to put down a few of the bits and pieces that I had this morning from the earlier session today, though you might have had a bit more detail in there. So we've got a parent, that's you, Peneketh, and I'm the 60% subsidiary that you acquired halfway through the year. And then the interesting thing is, on the second page, about point number 3, the examiner suggests that there was also an associate in the background, so you have to draw that associate into your calculations. That's extremely important. And then we went through the fair value adjustments, we went through the revaluations, obviously the associate. Then what else did we do? Some intercompany sales with pups, and then the NCI and the fact that the profit is shared equally throughout the year, evenly throughout the year. Those are automatic assumptions we make anyway. So we need to calculate the consolidated goodwill for 5 marks, as you can see. And then, of course, you've got to do the big P&L, which is 15 marks. I've given myself 3 pages with your approval on that. So where's my workings? Consolidated goodwill. We did all of this in the first session. We got as far as NCI being 150, therefore the total investment between the CI and the NCI is 396. What I'm lacking, of course, that's why I can't finish it, is the net assets at acquisition. This, of course, is a figure that's unknown at that stage, beg your pardon. So we now need to move along a little bit to the group structure and such like. All those adjustments we did. So if you need to know how we did all this and you were unable to attend the first session, please have a look at the recording. Otherwise, I'd like to just press on and get my net assets organized of the subsidiary at acquisition. So I'm going to say somewhere in the middle of my page at acquisition. And on the right, I'm going to say there's no need to do the CSFP because the question doesn't cover the CSFP. There's also no need to do associates because the only time you do associates there is when you're doing the CSFP. So I'm going to say in brackets, no need to do subs net assets at CSFP date, and no need for associate. Since not being valued for CSFP, not required in this question, but obviously in our travels through these 4 sessions, I've kept time aside to consider valuing the associate. We do that through an MCQ that the examiner set. All right. Otherwise, we're in business. The share capital of the subsidiary, very first paragraph of the question, 150 million. Or 150,000 in thousands. Then comes the dangerous one, the retained earnings at acquisition. Second paragraph of the question. Yep. Just after the first paragraph, I should say. Start of the year 120 plus 6/12 of 80,000 profit after tax for the year. And that gives me 40. And so if I grab these together, 160. And so you've got your working one to bring in. After that, fair value adjustment to land. If you remember, the land went up in the morning session, earlier today, 2,000. Plant went up by 6,000. No need to do depreciation because we're not doing the CSFP. 6 months later, then you have the customer relationships. Valued at 5,000, 5 million, whatever. And so as you add that up, you find yourself with 323. That is, of course, used for goodwill. Used for goodwill. It isn't actually goodwill, but it helps get the goodwill done on the first page. So let's flick back to the first page and finish off that goodwill, as we were half doing a few minutes ago. Here we are. Empty box, 323 goes in. And this, of course, is 73. Okay, so all very, very, very straightforward indeed. We're now under pressure in the exam to fill up to at least 2 pages, maybe more than that, of a nice long P&L. So if you put the morning's question, the earlier today's question, Pallister, together with Peneketh, and you do a little bit of homework, you can relax about consolidations. Okay, but you must do some homework, please. Right, CS P&L and the OCI, other comprehensive income. So we're going to ignore the associates. So let's bring all this into play. Where's my question? Oh yes, revenue 620. So painstakingly, line by line, I'm going to bring all this in. Revenue 620. The sub 6/12 of 310, which is 155 post-acquisition. And that 155 I'm going to bring in here, you see. As far as the associate is concerned, it's notably absent because obviously you ignore the associate because you don't control it. The intercompany sale, point number 4, have a look at that. 20,000. So I think it was a parent who sold. 4 of the question, and so left to right, 755. Then comes the cost of sales. $400 for the parent. For the subsidiary, it is 6/12 of 150 post-acquisition, which is obviously 75. Nothing for the associate, and of course the intercompany must be 20,000. These should always be the same, by the way. And so as you add downwards, maybe just before you do it, we must bring in our PUP, which was P sold to S working for, if you remember the figure was 800, and then of course P sold to the associate, called V, and that was 900 given, no problem there. Then you had some plant depreciation, which of course is working 1,500 was a subsidiary's asset, so into the subsidiaries column it goes. Excuse me, it goes. The adjustments are all going to disappear. And then what I've got to do is a huge big bracket. I'm going to put a couple of dashes in there, no bad thing. Huge big bracket, which has 6 items in it, 458.2. See? 458.200, which enables me to work out the gross profit, which is about here. You see? So we have here the GP, the gross profit, which is 218.3, 78.5, and the last one, of course, if I remember to put that in brackets, is the deduction. Yeah, must be in brackets. The figure on the far right, 296.8. Ideally, you should add up each column separately whenever you draw a line. And then right at the end, if it adds up, adds across, it must mean you're okay. Distribution, 40,000 parent, subsidiary 6/12 of course, of 20. Have a look, question paper, that's 10. Can't think of anything on the right, and therefore that should be 50,000. Also in brackets. And so we march along to the next challenge, admin. Admin was 36. 6/12 post-tax of 25 must be 12.5. And then you've got the amortization of the intangible customer relationships. Amortization, another way of saying depreciation of the intangible asset customer relationships. Working one basically. And that figure of course is 500. I think it was given to us. Anyway, there it is. A couple of dashes if you want to. And so you can grab hold of the admin, which has now gone up to 3 items, 49 brackets. And so we move along smartly. If you've got big handwriting, you could well be turning the page wherever it is for you. For me, fortunately, I have these e-pages, which are quite long, so I can continue. But if you have to turn the page, just be sensible. Don't write smaller and smaller as you come to the end of the page. Someone's got to mark it. So careful. The investment income external working, we did a big working, so might as well just bring that in. 3,200 for the parent. And a couple of dashes in here. And then for the subsidiary, I notice the subsidiary has got its own, you see. So I'm going to say 6/12 post-acquisition multiplied by 1,600 is obviously 800. Let me show where I'm getting this from. And by the way, if you want to add that up, this figure here is 4,000 without brackets. It's money coming in, income anyway. Okay, so let's see if I can, it's so easy, except that every little piece you have to think about. It's not a general exam where the general knowledge is enough to pass. It's very precise. Is it 6/12? Is it 9/12? Is it external? Is it internal? All these little things matter. That's the nature of our exam. People who don't like detail do struggle with F7 and they fail many, many times. And eventually they take the detail seriously and then they suddenly pass. So the 800 is half of this thing, you see. Half of that thing. So that comes through. Here we are. That's my 4,000. And so we move along to the finance cost. You can see that in the P&L. Parent is straightforward enough, 2,000. Subsidiary is obviously 6/12 post-acquisition of 5,600. Which makes it 2,800, somewhere around here. And then, mustn't forget, part of finance costs is the famous unwinding. Unwinding is given in this question, though we could easily work it out if not given. 6,300. Notice it's only for the 6 months between acquisition and the end of the year, because P&L spans altogether 12 months. The acquisition was in the middle of the year, so the unwinding couldn't have happened before the acquisition date. It's always after acquisition, and it must be in the parents column, because the parent has to find that money to pay the subsidiary. That's the way to understand it. Because even though the amount to be paid is a large figure, the parent brought into the goodwill calculation the discounted smaller figure. And then what had to happen was you had to build it back up to what it's going to be when you pay it. Okay, that's why it requires a little bit of thinking actually before the exam. But once you grab hold of these three, 11,100 you're left with to bring in there. Okay, so quite detailed. Every figure that you put in will earn you half a mark here, half a mark there, occasionally one, but most of the time it's lots and lots of halves. PBT, profit before tax. To make it look a bit more professional, let's have some of these headings in. So way up here, 218, minus 40, minus 36, etc. So where are we? 137.2. By now you would certainly have started your second page. Wherever. 137.2. The subsidiary, adding and subtracting all those numbers from way up near 78.5. As you work down the list, this comes to 53.5. All those adjustments disappear, and then on the far right we have 296. Take away a couple of items, add something, take away again, comes to 190.7. And obviously if that's profit before tax, what you need to do is to pause for a second and bring into play the famous associate treatment. Group share of associates post acquisition, profit after tax. So I'm going to take 30% group share, 6/12 post acquisition, and the profit after tax is given in point 3 of the question. Have a look at point 3 of the question. So they've given this in point 3, given it to us in point 3 of the question. So we're going to pick that up and sling that in. Notice I'm not bringing, this is the associate. I'll write in pencil, so to speak. The associate is 1,005. Notice I'm not bringing in the dividend because that isn't profit share. The rules are that you bring in the parent share, the group share of the profit after tax of the associate. You mustn't just bring in the dividend. And so this is 1,500. Less tax. Parent 45. Subsidiary 6/12 of 31, which is 15.5. And the associate, of course, is nothing on the grounds that this figure here is profit after tax. So if that's profit after tax, the 10,000, you can't take away the tax again, that'd be double taxing. And that's not right. And so as you add left to right, I find myself with 60.5 as being tax in brackets. So that profit after tax emerges. Profit after tax emerges for the year. 92.2, the first one, of course. The second one is 53, take away that, 38. The associate is that same 1,500 we had upstairs. The adjustments are all gone. And then the far right, let's add those up. 131.7. And so you come to the famous OCI, Other Comprehensive Income. Now, what do we have to do with that in our question paper? Let's go have a look. Very interesting. The gain or loss on the revaluation, it looks like this is a loss, and that one there is a gain. Okay, and there's some story there that the 3,000 is 2,000 at acquisition. I'm just going to bring this through. Please write 2,000 at acquisition. Of course, that affects goodwill. And so 1,000 is post-acquisition, which of course cannot affect the goodwill. Though of course the post-acquisition is shown in the consolidated OCI, because naturally you don't show the pre-acquisition for anything in the P&L. It's always post-tax. Remember that rule? So the examiner is saying, do you realize when you're revaluing, and there are two revaluations for the subsidiary, both of them gains, okay, two revaluations. The first one at acquisition would have gone into the goodwill calculation, but the second one, post-acquisition, wouldn't have gone into goodwill, comes into the consolidated OCI. Quite a clever point there. So here's our OCI. Gain loss, gain stroke brackets loss, on revaluation of land, which is P's 2,200 in original question. Have a look at that. I'll just say in original question. In the question, basically. Unprocessed by us. Given. So I'll hop across and bring that through here. And then, of course, you've got the land to do with S's. I think that was working 1 and 2, if I remember right. And that's to do with S's land, post-acquisition only. And that is a gain of 1,000, what we were looking at 3 minutes ago. You see? So that's only the post-acquisition that can come through, as we do throughout the consolidated P&L. You can't bring in pre-ac, it's always post-ac, the bit that's under your control. And so this famous item is called the total comprehensive income. TCI, they say. Total comprehensive income. Which is, as you add downwards, 90,000. The next one, of course, is 39,000. 1,500 is here for the associate. The adjustments have all gone. And this one, trying to add up each column independently, feels like 130.5. And then comes the moment of truth. Does this actually add across? And of course it does, if you've done it correctly. That's like balancing the balance sheet, quite an important moment in the exam, if you can manage that. Just one thing, the land, I just want to check my net assets list. I think it's there somewhere. The land, this is pre-acquisition, you see. Everything pre-acquisition affects goodwill. But the post-acquisition 1,000 for the subsidiary did not come into the goodwill calculation because that would have distorted it. Okay, so that's the end of the P&L. Then you've got to do this nasty little attributable to the NCI and the equity holders of the parent, etc. Little tail piece attachments. So let me show you what I mean by that. Here we are. Long P&L, gone into your second page easily, I'm sure. Run onto the second page, and you might even be starting your third page, depends on your handwriting. But I'm just going to continue with my little columns here. So you've got to do this new thing, or this additional thing called profit attributable to. Get marks for this bit. Profit attributable to, and we used to have an NCI, or have had an NCI throughout this question, and the profit after tax for the NCI must be that thing up there, 38. So I'll bring into play here 38,000 profit after tax. I'm going to multiply by 40%, and we'll bring that into play somewhere around here, 15.2. And then you have the equity holders of parent. Also known as owners. Owners of equity holders of parent. So easy this is. So if you leave a line, come to this level, this is 131.7, as we had on the previous page or higher up the page. That thing there, 131.7, profit after tax. So we'll deal with that first, then we'll do the OCI. And the figure that's missing, of course, is the balancing figure, 116.5. So that's your profit. Profit means profit after tax. We then have to bring in the total OCI, or total CI, comprehensive income, TCI, attributable to the NCI, which is of course 39,000, including the land revaluation. So I'm going to bring that in. 39,000, including land revaluation of 1,000, times NCI 40%, which is 15.6. I hope that's a little bit bigger than we had. Yes, it is, than we had before. And then, of course, you've got the equity holders, or equity of parent. If this is 130.5, the figure that's missing over here is, of course, 114.9. And that's the balancing figure, as you can see. So quite a comprehensive question with an associate that was hidden for a while and then revealed to you on the second page. And it has quite a few other tricks as well. Now, when I'm doing my MCQs with you in session 3, I'll be doing disposals of subs. Though some of the homework I've given you for this area of big consolidation questions, some of them have got little disposals for you to practice. And of course, foreign currency as well. I'll be doing that, as I say, during the main lectures, as well as during the homework. You can do some. All right, so that's the end of that particular question. I'll throw that aside, so to speak, and then pick up the next big challenge, and that, of course, is our published accounts. Let me show you why and how we intend to cover that. Here's your Peneketh finished off just now. And so we've got Kandy to come, published accounts and standards. As I say, if you download all that stuff I've highlighted there, you'll cover the homework as well. But the revision kit is extremely comprehensive. A committee of us have put it together, not just me, and we have many people thinking about it. So what you see there produced in that big revision kit is many, I'm sure, ideas, and goodness knows how many years experience gone into that, not just my years, okay? So you have other people contributing as well. So I think it's a good revision kit. So please do the homework I suggest. Now, one thing that's going to happen in the exam is if you're going to do your two big questions one after the other, which is what I'd recommend, because the MCQs are so different, aren't they? It's a different concept. If you're going to do it quickly in succession, you have to be able to switch off consolidation just like that and pick up published. Alternatively, published and interpretation, or consolidation, interpretation. It's very hard to do that, to switch between topics. But you have to practice that with me right now. And so if you turn to the September 16 for this coming exam, there's something called a specimen exam paper. And in that question number 31, about page 14, is the one that I'm after. Here we are. Published accounts and standards. If you remember, when you're doing published, there's only one way really to do published, and that is to do what's known as oral, O-R-A-L. So if I go to my last page, what are the required calculations? Prepare a schedule of adjustments. So I'm going to assume that can be accommodated into one page. I'll call that page 1. Obviously page 2, page 3. Therefore, workings could be your page 4. You see? And as you can see, extracts from the cash flow are just 3 marks. But I need to, as I'm reading the question, be aware that there are some cash flow issues. Okay, so that's why it pays to look at the requirements before you even read the question. So we do what's known as oral, something I was pushing on the main course when I did questions like interceptor, page 100, another one called altered when we did our advanced published, where we had to do some redrafting. Not unlike this question. This question obviously is worse. That's what revision is about. You move up and up and up. And that's why it's so important to attend these lectures. All right, so 3 marks using oral. So let's do exactly that. Open up our required accounts and then read the question, make adjustments, line by line solve. So let's go off and do our thing here. Let's say somewhere around here. Very easy question, but you have to switch off from consolidations. That's the challenge, really. September 2016, 31. Section C, question called Kandy, page 1. What does it say? Prepare a schedule of adjustments. So one of those redrafting type questions. So I'm going to say schedule of adjustments to retained earnings as at 30th of September 20x5. Put some dollar signs in. I'm just opening up what I can see, and then you've got some information in notes 1 to 3 above, which will obviously take time. And so once I've got that page nicely opened up, I can then prepare the next page, because I'm going to do a lot of my workings away from this page. I can easily fit it in. Page 2. Statement of financial position. As at X5 dollars and then you've got your page 3. Extracts from the statement of cash flow for year ended X5. Okay, so little extracts, really interesting word. 3 marks though, not to be ignored. And so I must keep time to attempt something like that right at the end of a long question. That's the difficult bit. It won't add up though, because only 3 marks is just an extract, but just faithfully bring in what you think is. For example, if you've sold a property for so many $1 million, that obviously is a cash inflow. If you've got depreciation, you know where that appears in the cash flow statement as an adjustment. So those kinds of things you need to bring into play. So that's my page 3. We're now going to page 4. Kandy. workings. So we have oral, stands for open up required accounts, then read the question, make your adjustments, and line by line solve. So this is the one I'm going to be doing the adjustments. Okay, so please revise all that when I do the when I did it with intercept and altered, and I'm sure if you looked at forest and other questions. So as per question, the first one, let's go have a little read now. So I've opened up, you must read, and then we'll adjust and then line by line solve together. But take some time reading the question. I'll give you a few minutes on your own now, please. So the year is 110x4 to 39x5. Debits and credits, of course. Interesting, the examiner is saying after preparing a draft statement of profit and loss and adding the current year's draft profit before any adjustments required by notes 1 to 3 below, the summarized trial balance, interesting. So he's checking your bookkeeping as well, your basic skills. And so these are $1 shares, as always, important. That's a share capital, of course. So this is where I'm doing my adjustments. So I've opened up my required accounts, I've read the question, I'm now rereading it, doing the adjustments. Every time I come across something worthy of explanation, I'll go on to my page 4 or whatever it is and write out something. So the marker can see my thinking process, my thought process. Retained earnings at the year end is said to be 15,500. I'm wondering whether that might be a good thing to bring into page 1. Let's go have a look. Yes, let's go back. The retained earnings as per trial balance, 15,500. Then you have your adjustments. As per workings, 0.1, 2, 3, etc. Okay, so let's see. Might not need one, but usually we would. It's normal to bring things in. So if that's the retained earnings at the end of the year, as per the trial balance, that indeed is the end of the year, that 30th of September date there. Okay, and so I'm going to say working 1, 2, 3 has produced whatever. So let's go back, have a little look at our specimen paper. Right, so the second item, extremely important. Proceeds of a 6% loan. Interesting, note 1, some story there, loan note. Investment properties, remember investment properties are revalued every year. The changes in value go to the main P&L, not the OCI. And the other point, of course, is investment properties are not depreciated because they're purely investments. In other words, if the company, the college occupies this building I'm in, obviously you must depreciate the building, charge to P&L. But if they put their money into some other building nearby or far away, wherever, and then let out that building for someone else to use, and the company themselves don't occupy that, it's purely an investment property. It's like buying shares in another company. Yes? Obviously, if you have shares, you get dividend. If you have investment properties, you have rental income. Okay, and so the dividend comes into the main P&L, and so the rental income from the investment property comes to the main P&L. These are similarities. But most importantly, shares are not depreciated, and therefore investment properties are not, because they're pure investments. Okay, so that's part of this question. IAS 40, clearly in the class notes, etc. But you must look up the class notes yourself. So investment properties, quite a lot of information there. Then there's some land given to you as 5 million in buildings, land and buildings at cost. So I'm thinking on the lines of the buildings being probably 30. If the land is 5 and the total is 35. Okay, now what else can I say? The accumulated buildings depreciation. So if I grab hold of these two things, looks like the carrying value is 15, isn't it? Carrying value, also known as net book value. 15,000. The plant and equipment, I could similarly do a little calculation. Maybe I'll just leave it for a second. Let's read on. Accumulated depreciation, lovely. That's at the start of the year, because clearly we have to do this year's. Then you have your current assets, your current liabilities, the deferred tax. If in doubt, this is always opening balance. Start of the year. If in doubt, it always is. Interest paid, current tax. If it's on the credit side, it must be an over provision. Let's see if in note 3 they give us any information with regard to tax. The second sentence, the balance on current tax and the trial balance is the under-over provision for the previous year. It doesn't really say very much. The examiner is leaving you to decide. So if it's on the credit side, it's always an over provision. If it's on the debit side, it's an under provision. Just remember that. Okay, so if it's on the debit side, it is an under provision, meaning you paid more than you provided because you under provided. So that'll show up as a debit item. But I don't want to get too much into the technical bookkeeping side. As long as you can remember, provisions are credits. So if you have a credit, it's an over provision. Okay, and so the other one is the other one. And then there's a suspense account, which I must get rid of somehow. A little later, they'll give you a story as to what the suspense account is all about. The following notes are relevant. The loan was issued on the 1st of October 2004. So what's our year? Have we written out the year somewhere? Yes, we have. So the loan note was issued on that date. So on first day of this year, okay, and incurred issue costs of 1 million. The loan note itself is given in the trial balance. Where's that loan note? Third item from the top, 30,000. The loan note, 30,000 trial balance. So I'm going to put in my little 30,000 somewhere there where I can see it. So if that's the loan note figure, it says issued on the first day of the year, careful, and incurred issue costs of 1 million. So you could say that the net proceeds are 29,000. Okay, in due course we're going to have to face all that. What's the gross proceeds, net proceeds, etc. So I'm going to write here, therefore, net proceeds 29,000. See? Which were charged to profit or loss. Interest of 1.8 million, they've shown you how it's worked out, was paid on that date. Good. That's the nominal interest rate, as I say. The loan is redeemable on that date. So it looks like it's a 5-year term. Is that right? Going to last for 5 years. That is a substantial premium, which gives an effective interest rate of 9% per annum. So the nominal interest rate is said to be 6%, but the higher one is what goes to P&L. So P&L, you always take the effective. Okay, just one of those things. So basically what's happening is you've raised something like 29,000, but you're going to repay much more than 29,000. Indeed, you repay more than 30,000, a substantial premium. And if you get hold of the extra money that you're paying back, so let's say you are the company, you're raising money, you've got this piece of paper, you see, the piece of paper that you raise, you call it a loan note. It says it's 30,000 or 30 million or whatever, but because you've incurred issue costs of 1,000, the amount of money you get is 29. So you give us this piece of paper and we give you 30,000. You've privately incurred 1,000, whatever, that's your problem, not mine. I'm a member of the public investing in your company. So we've given you 30,000. You had some costs, so you managed to get 29 net proceeds. But remember, we've given you 30,000. 5 years down the line, you pay us back not the 30,000 we gave you, but something much more than that. Yes, maybe 35,000 or something like that. And so basically what's happening is the extra 5,000, whatever it might be, you're paying us at the end of the 5 years. Clearly you can't just hide that through your reserves or the share premium, whatever. You've got to roll it back for the 5 years and charge a little bit more interest to your P&L. You see, so what we're saying is net proceeds compared to total payments, the difference is said to be 9%. And that 9% must go to the P&L. That's the idea. Now let me do a quick brush up on the basics, okay? In other words, if I can do some basic teaching as well as we go along, in case you missed the main course or you can't remember, or whatever the reason might be. So where's my calculations? Here they are. Here come the workings. Are you ready? Page 4. So the first working, of course, is the loan note. Loan notes. Thousands. On the far left, you have your net proceeds, which are obviously gross 30,000, less some issue costs, $1,000. Net proceeds. Okay, and against that, on the right-hand side, you have your total payments. So you have your net proceeds and your total payments. And the total payments, of course, are interest at the rate of 1,800 times 5 years, which is 6% times 20,000, 9,000. plus the repayment, including premium. And so this figure here, whatever it might be, so if I put this in a big circle and that in a big circle like that, the difference between the 29 and the whatever, 35 or something like that, that difference is what we call finance costs. Okay, that's called finance costs. Finance cost, and that is an effective 9%, and that's what you must charge to P&L. So you must always charge the effective to the P&L, because as you can see, even though you've paid 6% during the year, because you're paying this lump sum premium right at the end, if you bring that whatever thousands back into the P&L for the 5 years, is effectively, in round sum terms, about 3% per year. So 6% the normal interest plus 3% is 9%. That's how we get it, you see. Up to there is just completely optional. That thing I've just shown you is just me brushing up on questions like Ben-Hur and Moby from the main tuition course, from the chapter on financial instruments. What I need to do, of course, is something else called the movement of the liability. Movement of the liability, and that's where you get busy with the year, the opening. You then must charge the interest at the rate of 9%, always goes to P&L, the effective, less the interest at the rate of 6%, also known as nominal, that doesn't go to the P&L, extremely important. That's just paid out to the shareholders, the loan stockholders, and of course this is your closing. So that goes to P&L. This naturally goes to the SFE, but in no way should you try to split the closing into current and non-current. It's always non-current, all of it, because nothing's going to be paid in terms of capital next year. It's going to be paid in 4 years' time. That's why it's called non-current. Okay, so it's a bit like leasing, I suppose. Leasing comes up, of course, in our MCQs. So we've got here year 1. The net proceeds 29. So the big word is net proceeds. %9 thereon, I'll do it for you, is 2610. The interest given to us is 1800, that comes off, and therefore this is 29,810. So that's your SFB figure. Okay, so what goes into your main P&L, page 1? Let's go have a look. What might go in there? Let's see. Let's flick back a couple of pages. Here we are. Schedule of adjustments, 15.5. We need to add back issue costs of 1,000, because apparently those were charged to admin, so they shouldn't have been charged to admin. then you must deduct the effective finance cost. You see, in the trial balance, I'll just show you this for a second. Quite a clever point the examiner's made here. In the trial balance, you see, he says there's some interest paid of 1,800. Now, clearly, if you've got an item hanging around the trial balance, it can't have been reflected in this figure here. Because once you charge it against your 15.5, you wouldn't have the 1,800 left. You understand? The debit of 1,800, once it's written off, you won't have a debit, but you'd have 15,500 minus 1,800 sitting in there. Okay, 13,700, whatever it is. So if the examiner shows you 15.5 and then separately shows you interest paid, the assumption obviously must be that it hasn't been charged. That's the only thing that makes sense. Okay, so even though the money has been paid, it hasn't been charged. There's a difference between what's been paid and how much has been charged to the P&L. They're quite different. All right, so where are we? Effective finance cost. I better put that little thing in brackets, the explanation in brackets. Just an optional explanation if you want it. I'm going to put it down because at home you may be wondering about what happened there. So I'm just going to say the interest, 1,800, has not been deducted as it is in the trial balance in the question, awaiting write-off, you see. So the retained earnings of 15,500 is at the year end, not the start of the year, and yet that 1,800 hasn't been charged, which is why if I charge 2,610, then the figure would be right. Okay, so whenever they say 1,000 is charged to admin, it's nothing to do with the admin, you've got to take it off the finance cost. That's an important point. But the 2,610, what I'm trying to say is in another question, the interest of 1,800 might have been charged. So what you'd have to do is to add back 1,800 to the 15.5 and then deduct 2,610. But in this case, because it hasn't been deducted as yet, I don't have to deduct it or add it. I don't have to add it back or anything. I just deduct the 2,610. Okay, very important point there. All right, so that's under control. Now let's face the next couple of bits. Where's my question paper specimen? Yes, the 1 million that was charged to the profit and loss isn't correct. You must charge it to the financial instrument. Otherwise, this is sort of under control. We haven't done the balance sheet yet, of course, but it's going nicely. And so we come across this hefty paragraph or two. Non-current assets. On the 1st of October 2000 and... All right, so that's the start of the year. Have we got the dates down somewhere? I usually put it down somewhere. Yes, we have. At the start of the year, Kandy owned 2 investment properties. 2. The first one had a carrying amount of 15 million and was sold for 17 million. The disposal proceeds have been credited to a suspense account in the trial balance above. So that's what he's talking about. This disposal proceeds is basically that figure there. Okay, So I'll take it out of suspense and put it into the disposal account. That's my main concern. Very easy. We've done things like that when we did Altered, another one called Llama on the main course. And we do some homework, you'll see me doing it again and again, suspense accounts. Good one to master. Interesting that suspense account and this redrafting thing is in the specimen paper, which is an indication as to the future. Okay, be careful. The disposal proceeds have been credited to a suspense account. No longer, we've corrected that. At the end of the year, 31st, actually that's only a few months into the new year. So the new year begins on the 1st of October 2000 X4. That looks like about 3 months later. The second property, I see. So the first property has been sold off, gone. The second property, 3 months later, became owner-occupied. So what happened was, even though we had an investment property, we've got 2 investment properties out there. One of them you've sold for 17,000, fine, we can sort that out, profit or loss. But there's another investment property which we, because our business is expanding, Kandy, let's say our company is called Kandy, we are expanding our business. And so we decide, since we need more property for our staff to occupy and do their admin or whatever they do, let's pick up one of these investment properties, stop treating it as an investment property, charge depreciation for the first 3 months, okay, as a normal, or actually for the first 3 months, treat it like an investment property, so no depreciation, but the remaining 9 months till the end of the year, yes, we will depreciate it. So a bit of messing around with number of months, etc. Okay. And also, if you treat something as an investment property, there's no depreciation and it's treated as a non-current asset. And if you start bringing it into your normal depreciated assets group, obviously you have to do some slight reclassification there. I'll show you that in due course. No longer can it be an investment property, it's got to be just normal property, which means you must depreciate it. And it was transferred to land and buildings at its fair value of 6 million. Interesting little trick there, because I'm looking at this saying to myself, the investment properties described upstairs are said to be 20,000 investment properties. You see that? Investment properties, 20,000, seem to have 2 parts to it, 15 and 5 million. 15 million, 5 million. So that's property 1, if you like. This is property 2. Property 1 has been sold, so this must be property 2. I suppose it must be 5,000, 20,000 altogether. That 5,000 has been transferred to normal land and buildings at 6 million. So there's a small revaluation, I suppose. Okay, so it's gone up by 1 million. So that goes to the main P&L. So the extra 1 million, which is 6 minus 5, to the main, goes to the main P&L. The remaining useful life, at the date it was transferred, was considered to be 20 years. So I've got to start depreciating it. Ignore any deferred tax and all that kind of thing. I bet you didn't even think about that. So let's get that bit done at least over the next few minutes. My investment property concerns. So let's go to our workings page and see if we can get a few more tricks sorted. So have another read of that little section, please, that big paragraph. Non-current assets. All right, so that's those are our loan notes sorted. Move to the liability, lovely. And so I'll move into the second area, non-current assets. Any of these, and indeed many of these, have been MCQs, insofar as ACC have published it and I've been able to see it and talking to students, of course. So let's do it in little manageable bites. There are two investment properties. All right. And in the trial balance, they seem to be sitting at 20,000. And clearly that 20,000 is made up of 15,000 that's now sold and 5,000 that you are transferring, TRFD, transferred to land and buildings. Okay, that's very much a balancing figure. So I'll do it very slowly so you have something to write down and take away and think about. So two investment properties, be careful. So what can we say? Quick brush up on the basics. IS 40 says annual, every year, got to revalue. Changes in value plus rental income go to main P&L. But had they been ordinary properties, land and buildings, not investment property, they would have gone to the OCI bit, like we saw in the consolidation question. And the third one is there's no depreciation. Okay, so that's a quick revision of a very small standard that comes up from time to time. Be careful. One of the homework questions, called Kingdom, I think it's called, has a bit of investment properties as part of your cash flow question. All right, so that's a quick brush up. Where are we? Two investment properties, that's all we've said. Let's pick them up one by one. The first one, 17,000 sold for. So I'm wondering whether I can remind myself that this is a cash inflow and it should go into investing activities. And then you can deduct from that 15,000. That's your book value. And so that difference of 2,000 profit P&L. The second thing I'd like to do is to bring into play 20,000 minus 15,000, therefore just 5,000, but transferred to land and buildings at 6,000, 3 months after the start of the year. You see? So there's a revaluation surplus of 1,000. Revaluation surplus of 5 taken away from 6, 1,000. And that goes to the main P&L. Depreciation on property coming up next. Is 6,000 divided by 20 years multiplied by 9/12, 1st January to 30th of September, x5. And so if you tap into your calculator, this looks like 225. And that, of course, is the famous depreciation, which ends up in the P&L. So notice how I'm doing it. Quite a daunting looking 2 paragraphs plus 2 small paragraphs. So 2 big and 2 small, lots and lots of paragraphs there, all under point 2. I'm picking out each sentence of each paragraph and just trying to sort something out. That's the only way, really. Very few people can look at it and say, oh, this is the answer. Even prize winners have to take their steps carefully. Okay, so you have to be very, very conscious of the fact that this isn't, a gift paper. You've got to fight for your marks. It's not technically that difficult, just huge, we were saying. But you can see there are ways of scoring quite a few easy marks. So that's your investment properties story. Let's move on to the next paragraph. The price of property has significantly increased in recent years, it seems. So we've got as far as the 225. Now let's go for the non-investment property story. So the first paragraph sort of under control. The price of property has increased significantly in recent years. And so the directors decided to revalue, I see, revalue the land and buildings. The directors accept the report of an independent surveyor who on the 1st of October, that feels like the start of the year, doesn't it? In one of our questions on consolidation, the revaluation is done at the end of the year. You saw that. We underlined the word end, I remember, a few hours ago today. Now we're doing at the start of the year. So we see end and start. And so the principles are quite simple. If you revalue at the start of the year, you revalue first, then you depreciate the higher value. If you revalue at the end of the year, obviously you depreciate first, then you revalue. In other words, just use common sense. Don't get confused by that. Just read the instructions and do it accordingly. So there's a revaluation in this particular question at the start of the year. Value the land at 8 million and the buildings at 39. So I'm wondering whether I could put into my little column here, a little bit of space here, the fact that this is 47 and it was in present age and condition. Where's my properties? 15, that figure there. So it was 15. So the revaluation surplus feels like 32. You see? Which in due course, I'm going to multiply by whatever figure they give me there, deferred tax, 20%. And so the figure there is deferred tax, something like 6.4. What that means quite simply is really simple idea. 6.4. What they're saying is if you were to sell the building, the revaluation surplus becomes taxable. And so what we do in accounting is make some kind of guess at what the tax might be. You see? So if a company sells a building, obviously has to pay some extra corporation tax on chargeable gains. And even though in F6 and real tax, it's much more complicated than that. But the simple idea for accounts purposes, to be prudent, whenever you revalue, you always charge deferred tax on it, if the question tells you to do it, of course. Okay, but in terms of the director's intention, even if there's no intention to sell, you must provide deferred tax, because the directors could well say to you, don't charge, if you're the accountant, don't charge deferred tax on it, because we don't intend to sell. And then come the next year, they change their minds and say, oh, we are going to sell. And of course, the company is left unprovided on deferred tax. So one of the little MCQs that we got, that I saw a few sittings ago, we were asked, do you provide for deferred tax or not in these circumstances? And that was 2 marks worth. So my suggestion is, whenever there's a revaluation, be seeking to provide deferred tax on the revaluation surplus. They'll never make it a revaluation deficit downwards, and deferred tax therefore turns up as negative. The examiner doesn't do that to you at this F7 level. If you go up to P2 in 6 months, 3 months, 6 months' time, whenever you do it, the more advanced corporate reporting, there they might have things like that. But I'll leave the lecturer there to explain all that to you. Okay, so at our level, revaluation, deferred tax. Revaluation, deferred tax. Unless the question says don't do it, in which case you don't. So let me commit all this to paper to feel that we've got something solid written down. And at some stage I ought to give you a break, really. Let's see if I can get a few more bits down on paper. I might start another page, actually. Say page 5 or so. Workings continued. Non-investment properties. Next. And so the first thing in the exam is to ask yourself, this revaluation, is it at the start or the end of the year? And this question, of course, is at the start of the year. Always makes life a little bit easier. So you've got your land, which is 8,000. You then got your buildings, which are said to be 39,000. And then the total now is 47. The buildings, meanwhile, are depreciated over 15 years, remaining life. Which is, of course, 2,600 per year. Depreciation for the year. Full year's depreciation, because the revaluation was at the start of the year. So if you revalue at the start of the year, the whole year will see higher depreciation compared to had it not been revalued. Okay, that's just a side issue. Let's go back to the main flow of ideas. That is what it is now. It was 35,000 minus 20,000 depreciation to date, also known as accumulated depreciation. So I suppose this number here is 15. Thereby you can see the revaluation surplus emerging as 32,000. So easy. Naturally enough, you've got to ask what's the deferred tax rate, 17%, 20%, whatever it might be. And so that figure there, 6,400, is what you must do. Okay, very important. It's one of those things where students are very weak. Yes, they're terrified of that thing, never heard of deferred tax, haven't done any studying. I was doing a revision course recently and a couple of people there, maybe the revision course came too early for them. They hadn't done any work. And so they were panicking. Everything I asked them to do, came around, had a look, no idea whatsoever. And it just shows that, if people haven't done any work, they're not going to pass. But the only good thing was that course was a week ago. And so people have had, a bit of time to catch up, we hope. But here we are, you and me together at this point, trying to use these precious days as best we can. So there you have deferred tax. We also had some depreciation upstairs, and then some other depreciation on the previous page, you see. Investment property reclassified. So let's go for total depreciation. Reclassified. Second investment property, 225. Then you have your buildings. Above that, 2,600, I think we had. Yes. And that's 2825. P&L. And then in the SFP, Statement of Financial Position, we're going to have our land and buildings transferred from investment properties. Yes, so we have transferred from investment properties 6,000 plus normal land and buildings, this thing here, 47. Minus depreciation for the year, said to be 2825. Okay, so you can put the whole thing together like that. Seems like a good idea as we tidy up some of there. 50,175 is the final score. There you are, 50,125. Now, just as we conclude on this little matter, can I ask you please to knock out the plant and equipment depreciation? See that thin paragraph? Second last paragraph under point 2. Quick plant and equipment, please. How much? I'll stop for a second, give you a chance to run ahead, please. So here we are. Plant and equipment. The cost, 58,500. Less accumulated depreciation at the start of the year, 38,500. $24,000 less depreciation for the year at the rate of 12.5%, 1/8, something like that, of 24. Feels like 3. Which 3 I'm going to take out like that, reminding myself to put that into the P&L. And then the net book value emerging here is 21,000. Carrying value, net book value, call it what you like, but it must end up in the SFP. Okay, so all these little P&L bits and pieces I need to bring through onto page 1 where the action is. Okay, so that's quite a standard layout for reducing balance depreciation. Reducing balance depreciation, careful. So you have different kinds of depreciation. That one is called reducing balance. Just run through that once more, please. And when you're ready, let's go back to our page 1 here somewhere. Yep, here we are. Started with 15.5, added back 1, took away 2610. Gain on disposal of the first investment property, I've got to bring that in somewhere. So let's say add gain of 2,000 on disposal of the first investment property, 2,000, no brackets. Then you have the transfer, or shall we say the gain, I'd underline the word gain, on revaluation of investment property just before, prior to transfer to non-current assets. You see? And that goes to the main P&L. Says IAS 40. Goes to the main P&L, says the IAS. And that figure, of course, is 1,000. You see? And then you've got some depreciation to come off. Buildings. The total, I believe, was 2,825. Was it 2,600 and 225, something like that? Go check. Working 2. And of course, we've got a depreciation of plant and equipment, which we saw was 12.5% of 24,000, I believe. Yes, 3,000. And then from that, I'll take away tax, because obviously retained earnings is after tax, always. So I'll keep my options open and begin to read that particular issue in my workings, in my question paper, I mean. So no depreciation has yet been charged to any non-current asset. So once you've done it, of course, you can tick it off. And then it says tax. A provision of 2.4 million is required for income tax on the profit for the year. The balance on current tax could be an under or over provision in addition to the temporary difference relating to the information in note 2 above. Kandy has further taxable temporary differences of 10 million on that date. Quick check of the next page. Yeah, nothing to do with us. Pretty serious paragraph. So I'll tell you what, let's have a break. 5 minutes or so. And when you come back, we'll finish this question and see how the time goes to do anything else. Okay, so do have a little relax for a few minutes. Thank you. Right, let's resume our battle with this question. We've done our difficult bits, that is to say the investment property and two investment properties. One was sold, one was transferred partway through the year, a bit of messing around with depreciation. And then the other properties have been revalued, and of course, if you revalue at the start, it affects depreciation for the year. And then there's deferred tax on the revaluation surplus. So quite intense. That's something I've noticed with the examiner recently. The questions are getting a bit less general and much more precise, very deep. Yes, so the person who's prepared has no problem. The person who hasn't prepared is struggling. And that's why the pass rate has fallen slightly recently. But hopefully with our help, we'll, get that pass rate up. Well, we'll certainly pass. Right, now, tax, 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 tax. Have another read of that, point number 3. Okay. So where are we? Let's see if we can get something set up here. Maybe another page, maybe an idea. For me, it's about page 6, I believe, something like that. Kandy. Excuse me, don't know how many times this has come up. Excuse me. Workings. All from the class notes. Excuse me. Tax, the spelling of tax is not T-A-X, but it is, you're right, C-U-D. C, leave a line U, leave a line D. Current tax, current year, sometimes called income tax, 2,400, says the question. Okay, so you have to go about it with a bit of confidence, as I'll show you. The provision of income tax is basically your C of CUD. Here we have, I believe, an over provision, so that's the O, C-U or C-O-D. And then the D, of course, here is a little bit more serious than most questions. So the D needs to be calculated. Okay, so that's slightly above average, I would say, the difficulty there, especially where part of 3 depends on getting note 2 right. There'll be a way of marking whereby if you get note 2 wrong and you've been penalized in note 2, when they mark note 3, they'll mark the wrong figures you're bringing through as if they are right. So it's the principle that gets you through the exam rather than perfection. How many of us are perfect? I certainly wasn't as a student. Obviously way above pass standard, but certainly not 100%. In fact, even prize winners only get 90-odd%, so we don't have to get everything right. What you do has got to be quality, top quality. And any good student, done a bit of work, should be in that situation. And I certainly passed based on workings, good quality workings. Okay, so provision, over provision in this case, for previous year, in previous year. As we saw before the break, that's 1100, and overs are always in brackets. So I'll just brush that up. Don't forget the under is a debit in the trial balance, or a debit in the P&L equals an under. Just as a credit in the trial balance, I should say, is an over. Okay, so brackets for over, because basically in the past you over provided. So if you take last year's over provision by 1100 and this year's bracketed item, it'll sort of iron itself out, even itself out. Now comes the trickiest part of this question, I think. Deferred tax transfer. So you must put in words like deferred tax. Don't just say D, because that's foolish. The examiner will know what you're talking about. Okay, here we are. That's your P&L charge in due course. And then I'm hoping that down here we can have our deferred tax in the SFP. That's P&L, this is the SFP. And this, of course, is your non-current liabilities. You see. So what do we have? In our trial balance, we have an opening balance, which stands at 2,500. So if in doubt, the trial balance items are always opening. Okay, opening deferred tax. Leave about 6 lines or so, 5 lines or so, and come down to here. So leave a decent gap. This is your closing. And the closing is made up of 2 things. We have the revaluation surplus tax, which I believe was 6,400 from our earlier workings. Let's see where I can find that for you. Revalued. Yes, 6,400 is very important deferred tax. So I'm using that as my starting point. Careful. Okay. Then comes, let's go have a read of the question. In addition to the temporary difference relating to the information in note 2 above, Kandy has further taxable temporary differences. These are things like your capital allowances, tax allowances, are given at a faster rate than your depreciation is claimed. That kind of thing. Okay. Other taxable differences. And apparently that's 10 million. And clearly 20% of 10 million, the tax rate has been given, is another 2,000. In a roundabout sort of way, the examiner is saying your deferred tax closing balance is something like 8,400. 6,400 revaluation, 2,000 capital allowances, whatever reason, other bits and pieces. So that, be careful of that. So quite apart from that, we have the further taxable temporary differences, which are said to be 10,000. And if you multiply that by 20%, the figure here is 2,000. So if you add these up, this figure here is 8,400. And so the figure that's missing is something like 5,900 over here. Now here comes the big moment. This is a balancing figure, of course. That's just a balancing figure. Because I've got 2 closing balances, the closing figure is quite high, 8.4. It started off as being 2.5, and so the difference is 5,900. Now don't forget that in these particular circumstances, you can't just blindly take 5,900 to the P&L. You've got to stop and say, oh, no, there are 2 parts to that. One is the deferred tax transfer to revaluation reserve. So I'll just come up here. The deferred tax transfer to revaluation reserve, which is sort of a debit reval reserve and a credit deferred tax, and that figure is 6,400. In other words, this is nothing but this. Okay, but what makes this question quite awkward is the P&L transfer. So I asked for a few lines of a gap between the opening and the closing. The P&L transfer, if I'm trying to make sense to the examiner, must be 500 in brackets. That too is a balancing figure. So it looks like you do your opening balance first, you do your closing balance second, given that there are two parts to the closing balance, reflect the deferred tax transfer to revaluation reserve as a little item between the opening and the closing, and then whatever's left goes to the P&L. Okay, so it is this figure here, P&L transfer, that I must take upstairs. So that figure there, it goes in here. $500 brackets. $2,400 minus $1,600 is something like 800. So that's your P&L charge, made up of all kinds of things behind the scenes. Revaluation surplus tax. Okay, for more practice, look at the class notes towards the end of the deferred tax chapter. Maybe I'll just write that in here. Review, revise, class notes towards the end of deferred tax chapter. There's a whole chapter. It should be around page 208, 209, somewhere around there, but I better let you check that. I've explained examples such as this. All right, so I'll leave that to you. Now, my only other concern, of course, is putting all this through onto my P&L, page 1. So it's a bit odd that the overprovision is so big and the deferred tax transfers also in brackets, and so the figure that ends up in your P&L is much smaller than the current year tax. That's absolutely fine. Just one of those things. This is then our examiner's new style question, so be prepared for things like that. That journal entry I did, the reason why I'm bothering with these little journal entries is when I'm doing the specimen paper MCQs with you, you'll see on the odd occasion the examiner will say, now if you have this foreign currency item, what would be your journal entry? Or he'll say, you know, if you've got a provision for unrealized profit on the parent cells or the subsidiary cells or whatever, how does that affect your stock, your inventory? Can you please choose one of these 4 journal entries, A, B, C, D? Okay. Another way he might do it is he might not set what's known as multiple choice. He might do objective testing. In other words, you calculate a figure and just drop it in for PUP. You see, so be prepared. That also is in the syllabus, what's known as objective test questions, where there's no A, B, C, D. You just have to make up a figure and drop it in, type it into the empty space. Right, the retained earnings has been given. We've got the 1,261 in brackets, 2,000, 1,000, all kinds of items. And so we now come to the tax. So point number 3. Tax charge for the year is 800. And so the grand total 10,265. And that's your adjusted retained earnings. 10,265, excuse me. So where are we? Let's go off and finish our SFP balance sheet. And then we've got to do bits and pieces on the cash flow as well. All quite a busy question, and if we have time we can make a start on some of these MCQs. All right, so there you are. Schedule of adjustments. Excuse me. You have to use your imagination. What has been done, what hasn't been done, that kind of thing. So the statement of financial position, assets. Now it's just so easy, you just have to jump in there, sort out all those items. Now, fortunately, in our trial balance, we have quite a lot of detail to get us started. For example, there are items of investment properties and which have now gone, I suppose, because you sold one and you occupied the other. So I suppose there's no investment properties left, but there are property, plant and equipment items. 50,175 is your land and buildings. 21,000 is your plant and equipment. Together, 71,175. Then comes your current assets, which I'm going to lift out of the trial balance. I can't remember any change to that. So that is 68,700. And so we've got here 139,875. Total assets. So where's this coming from? The land and buildings, 50,175. Let's see if I can find it for you. The land, yes, there it is. The investment properties have all gone, and you've got normal land and buildings and the special transfer from investment properties, depreciation, etc. So that goes in. As far as your plant and equipment is concerned, I could have added it up, the two assets, but I've decided to keep it separate. 21,000, whatever method, as long as the examiner can see what you're trying to do. So let's go back. Here we are. No IPs, all gone. No investment properties. Because they've all been either converted or sold. No IPs left. Okay. We then come to our equity and liabilities. We have our ordinary share capital of equity shares. You're supposed to say whether they're $1 shares or whatever. And that comes from the top of the trial balance. Sling that in. Lovely. No problem. 20,000. Don't think there were any new shares issued. I can't recall any. So let's march on. We then have our revaluation surplus. Which is 32,000 working to less deferred tax, you remember, 6,400. So this figure here, I might show it a little bit to the left actually. Might look a bit better down here. 25,600. Then you have your retained earnings. Excuse me. Retained earnings, which is basically the answer to part A of the question. And that, I believe, let's go have a look. What was that? This one here, we had, there is 10,265. So I'm going to drop that in and hope for the best, that it will add up. 10,265. And adding across 35,865, which when added to the 20,000 higher up the page is 55,865. And so you have your non-current liabilities, deferred tax, working 3, 8,400. Then you have your 6% loan note, working 1, 29,810, which is obviously 38,210, and so it goes on. Let's see where all these numbers are coming from. The deferred tax looks like the tax you've kept aside, you provided for the revaluation surplus of 6,400, and then the capital allowances and so on provided 2,000. So 6,400 plus 2,000, 8,400. 8,400, easy. The loan note requires a little bit more care. So if I move into my loan note section, we have this thing called movements of the liability, 29,800. And to be honest, in the exam, you just need to do this bit. Okay, so this is needed. The upstairs bit there is all explanation in class, just to get you into, if you missed the main course, can't remember, quick revision. But the bit that's really needed is only that bit, the last bit there. Okay, so the closing balance is 29,810. In the P&L, we took 2610. So all that is perfectly in place. So where are we? Let's go back. Statement of financial position. All going quite nicely. Just copying out things from my workings, nothing clever really. Then leaving a line, we have our current liabilities, trial balance, 43,400. Then we have, the current tax payable. And as you know, you have your CUD, and as I've said before, out of the C and the U and the D, all this stuff you don't need for the balance sheet. You mustn't bring that in. Just the C of CUD, or COD if you prefer. So just the C comes through, which means the figure is 2,400. So what 2,400 is that? Excuse me. Let me show you. The total of the tax that goes to the CUD mnemonic for C. This one here, that goes to the SFB. And of course the deferred tax goes in as non-current, as we saw a moment or two ago. Very, very easy stuff really, if you practice a little bit. So we're nearing the end of our SFP. Hopefully it'll balance. If we're careful, it should really. And so as you add that up, you come to 45,800. And now comes the moment of truth. 45,800 plus 38,210 plus 55,865, 139,875. And so that's your total equity and liabilities. I realize in that question we had a fairly straightforward finance cost, a slightly awkward investment property paragraph, but then a straightforward revaluation of ordinary property, then a much easier than all of that, reducing balance, depreciation on plant and equipment, and then you had a pretty okay tax, apart from the deferred tax area, which you have to be a bit careful with the revaluation. And of course the P&L item ends up in brackets from deferred tax. So I would say that's a really good question to master, because it has, 4 or 5 tricks in there. So that adds up. Now we haven't quite finished, because the question surprises us, as he does from time to time, by saying, what's just been happening? Can you sort of think of some cash flow items from that question, and indeed your solution? And we say, sure, we can give it a go. So, excuse me, we certainly sold an investment property for 17,000, which looks like a bit of some money coming in. See the proceeds. So let's see. How can we convert that into cash flow type items? Now, that's a bit awkward at the end of a very busy question. So how do we do this? The question says, if I can just look at the requirements once more, for operating and investing activities. So you must do this, says question, for operating and for investing activities, not for anything else. So, and also operating and investing regarding PPE, property, plant and equipment. So quite narrow. So let's head it up to indicate that you didn't miss that point. Operating and investing activities regarding PPE, regarding PPE only. Right. Excuse me. Cash flows from operating activities. You start with your profit before tax. Don't know. You then must add back things like depreciation. Now remember, my buildings depreciation stood at 2,825 and my plant and equipment depreciation stood at 3,000. So if I grab hold of all of that, the depreciation that comes through here is 5,825. You then must deduct gain on revaluation of investment properties, 1,000. And then, of course, you deduct the gain on disposal of IPs, and that is 2,000. So all these together come to here. Okay, so these are non-cash items. I suppose these are as well. And so what you do here is the opposite of what was done in the P&L. Okay, so can I suggest do opposite of P&L treatment? Please do the opposite of what was done in the P&L. Extremely important for me to say that. All right, so a few bits and pieces there. The other thing I ought to say is, can you just study, please? Study somewhere, page 310 of the class notes, if you have access to them. Don't worry if you haven't, if you've been at some other college or, or wherever. I'm sure you've got access to the format. Okay, so this is the format, the pro forma for your cash flow statement, where you see this kind of thing happening. You add back depreciation, you deduct this and minus and add that, and that kind of thing by studying page 310 of the cash of the class notes. You should see all that there. All right, leave a line or two because I want to grab 3 marks here. So the marker must realize I'm doing something different. So leave a line or two, at least. Cash flows then from investing. See, activities. And here you have your proceeds from sale of IPs. This is, the first IP, investment property. And the proceeds was 17,000. Notice he's not asking us for financing. That's why I don't have to bother with the loan note monies that came in, etc. Just the operating and investing. A very unsatisfactory kind of thing to do because it doesn't add up to the movement in the bank balance. If they give you last year's, of course they haven't given you last year, so there isn't a huge amount more you can do except hope for the best that your P&L is correct, your SFP of course balances, which is great, and the cash flow there, very, very awkward little point, as you can see. All right, now where are we with regard to our program? I pushed you hard, sorry about that, but I was keen to get lots and lots of things done. So if I take you to the program once more and direct you to doing some homework, I can then perhaps move on to what's going to be a very busy next week. So I just want to take the pressure off a little bit. So where's my study planner? Kandy, fine. The questions that I'd like you to do on this side, Quincy is really good. So if once you've got past this, I'd like you to move to Quincy, Clarion. Clarion, of course, is June 2015, which is here. And then a couple more from the revision kit, like Extol. That's another really good question. Tumale you can leave aside. But Quincy and Clarion are super questions. New style questions, as you can see there. There's also the December 2014 specimen when the first radical change was introduced into F7, and we've hardly got used to that, and there's another big change not even 2 years later. So it's all change really. It's very hard for you as well as for me, changing all these tests and so on. That's why I say if you can do the revision mock, I'll mark it myself, and it gives you a feel for the exam and gives you practice. I suppose the kind of issues we are thinking of is when I go into that exam, I've got 3¼ hours as a well-prepared student, suppose. Do I do my MCQs first? Do I do my 2 big questions first? You have to practice. So what you could do in the revision mock, you might decide to do the MCQs first. But then you've overrun slightly. You've come to your 2 big questions and you're rushing. And then you think about it, and on reflection you probably would say, maybe I should have done the two big questions first. Just my personal, the way I behave in an exam as, a typical student. That's yourself. And so in the exam you might think, no, I better do the big questions first. And then once I've got that organized, because they may be quite detailed, I'm calm and relaxed when I first go to the exam, sort of. And then I come to the MCQs and I can guess a little bit and get that out of the way. Because MCQs, on the edges, one or two questions you might not know, might have to guess. But in doing the big 20 markers, you can't really guess, because those are real questions. So it's something that you've got to do, you see. So try out these revision mocks, the revision mock, either do the MCQs first or the big questions. Doesn't work, the real exam, do the big questions and then the MCQs, that kind of thing, or vice versa, whatever grabs your fancy. As many of those as possible, please. Extol also is a good question. Now, as I move on, if I can just begin to do a few of these MCQs, as you can see, our first session on Monday next week is going to be extremely busy, so I wasn't sure how much time we would have today. So I'm going to go for some of these random mixed MCQs since we have a precious 20 minutes together. Knock out 2 or 3 of these because I've got to do 15 of them and 3 massive scenarios. Telepath, neutron, that's an awkward one, and speculate. Speculate also has got some financial instruments and stuff in it. Okay, so from the specimen paper, I want to do a few questions. So, where are we? So where's that specimen? Here it is. Going back a few pages. Here we are. Applicable from September 2016. As you can see, Section A, all 15 marks are compulsory, must be attempted. In fact, the whole thing is compulsory. So you've got 15 and 15, 30 MCQs and 2 big questions, 32 questions altogether. Sounds like a lot, but 30 of them are just 2-mark exercises. Don't forget when you're doing these little random MCQs, if you get one question that you look at and say, it must be D, don't feel bad about it, because the next one you have to do might require lots of calculations on leasing or whatever. So all I can say to you is these exams are sat by a sitter who obviously isn't allowed to teach the, for F7, but one of the examiner's colleagues does it, and someone he knows, and that person would wear the hat of a reasonably well-prepared student. Not a prize winner, not someone who's done no work, but just a well-prepared student. And that person is given 3¼ hours to do the question. So it's all tested. The examiner shows me that if some questions are, have no numbers, you can do it in 40 seconds, even though the average length of time for all the MCQs is 3.6 minutes. Okay, 3.6 plus reading time. So that's the average. So let's give this a go. All 15 questions. Bring these little specimen papers and things in next week. All 15 questions compulsory must be attempted. Use the grid provided. Just follow the instructions. So they'll tell you what to do. Each question is worth 2 marks, i.e. 3.6 minutes plus a few seconds reading time. So I suppose if you were to think about the reading time, that 3.6 could go up to 3.8, might even be 4 minutes. Okay, so just under 4 minutes. Which of the following should be capitalized? See that? Should be capitalized in the initial carrying amount of an item of plant. Capitalized means treated in the SFP. Cost of transporting the plant to the factory. That looks good. Cost of installing a new power supply. Yep, that looks good. Cost of a 3-year maintenance. No, don't like that. Cost of a 3-week training program for staff on how to operate the plant. In other words, you send me on a 3-week course on how to use that expensive plant. Yes, and I'm an employee of yours. The trouble is, at the end of the course, I could hand in my notice to you. You're my employer, I'm the employee. And I'll give you whatever, a month's notice, and I might walk away with all those ideas of how, what I learned on that course. So human assets, as a rule, are not allowed to be recognized in the SFP. Some football clubs do it, and they get away with it, because I suppose without the players there'll be no club. So they're the only exception, really. If you send staff on a training course, that can never be accepted. All this is on page 109 if you have access to my class notes. So is that option available? Indeed it is, part B. Notice even with all the explanation, it got nowhere near 3.6 minutes. In the exam, of course, you don't have to justify why you haven't selected 1 and 2 and so on, or why you haven't selected any of the A, C, and D. Yep. So you just have to choose one and move on. Let's try the next one. Have a little read. So we've done one. When a parent is evaluating the assets of a potential subsidiary, notice the word potential. Maybe it's not a subsidiary yet. Certain intangible assets can be recognized separately from goodwill, true, even though they have not been recognized in the subsidiary's own individual statement of financial position. So, for example, if the subsidiary has research costs, as you know, research and development can be carried forward, but research you must write off. So the subsidiary is written off research, but if the parent sees value in the research, then it can be treated as an asset. Slightly surprising point. So that might be relevant. Let's see. Which of the following is an example of an intangible asset of the subsidiary which may be recognized separately from goodwill, etc., when preparing the consolidated? So what they're saying is there's a difference in treatment between what the subsidiary individual accounts does and what the consolidated accounts do. A new research project, absolutely you don't have to read much more. The subsidiary has correctly written off to P&L. Expense means written off to P&L, but the directors of the parent have reliably assessed to have a substantial fair value. It looks absolutely solid and good. Now the nice thing about A, B, C, and D, and the examiner says which of the following. If you can come down to one of them being the most genuine, you can almost walk away and start the next question, but maybe check quickly. A global advertising program which was concluded in the previous financial year. Maybe that word previous means it's sort of too late to consider now. You see, so expected to flow in the future, etc. So that is close, but A looks better. So making a judgment, choosing the best one. A contingent asset of the subsidiary from which the parent believes a flow of future economic benefits is possible. Contingent asset is never, we don't recognize, okay? Contingent asset is not recognized, by the way. Never recognized. So don't like that. Marginally don't like B, but A is better than B. A customer list which the directors are unable, don't like that. If they can, that's different. So the examiner is basically pointing you towards A, and that's your 2 marks. So as you can see, the first 2 exercises there, even with a bit of explanation in class, they don't get anywhere near 3.6 minutes, 4 minutes each. So in the exam, if you were just asked to choose, okay, in question 2 you have to think about B a little bit, but A is so solidly the answer, you can almost do that within a minute. You can certainly do the question 1 within a minute. So notice I'm building up a bank of minutes which I can invest in my question 3, which requires, as you can see, wherever there are numbers, you have to slow down and do calculations, etc. But where they're just concepts, just read it a couple of times and you've got your answer. So the examiner has assured us, and face-to-face he's said it to me, tell your students that a few of these will be numerical, a few will be discussion, more or less half and half. Though in the scenarios, you have to keep some time for that because they tend to have numbers. So you've got to be careful. Get rid of these quite quickly, the warm-up section A. All right, on the 1st of October 2004, X4, Flash acquired an item of plant under 5-year finance agreement. The plant had a cash purchase price of 25 million. See? The agreement had an implicit finance cost of 10% per annum and required an immediate deposit of 2. Therefore, the amount outstanding, I would say, is 23 million on which you charge your interest. And annual rentals, the word rentals, what he means is installments. So slightly, unclear word. But the moment you see 10% and so on, you know it's a finance lease. It says so anyway. So the word rentals, we'll excuse the examiner. I would have used the word installments. But rentals, well, we'll have to accept it. 6 million paid for each of the 5 years. Now, the different ways you can approach this. One is to say, okay, I always do step 1, step 2, step 3. Another way to do it is say, well, what do they want me to do? Concentrate on that and don't do too many workings. Remember, these MCQs are marked by computer. So the computer will look at question 3 and say, yep, the answer is B, or whatever it might be. And that's it. They don't have any, computer has no feelings. It won't say, well, A was quite a good attempt, so maybe I should give them 1 out of 2. Nothing like that. It's right or wrong. And that's a bit harsh because a human being might have given you half a mark out of 2 if you presented nice workings and so on. But that's the way, unfortunately, ACCA is going. It's all right or wrong. It's all a knowledge test, it seems. So what is the current liability for the leased plant in the statement of financial position at that date? So that looks like the start of the year, the day it started, I mean. That first date. And this looks like the end of the first year. So this is the first year end. So how do I do this? As I say, you can do it on a separate page, but since it's all there for me and I'm trying to explain how to do this, just check the next page. No, that's something else. I can just about do this on the face of my question paper here. I've got enough room. So if you want to, you can. If not, do it separately. Absolutely up to you. So I've got the year. I've got the opening. This is the movement of the liability. We've got the finance cost, which is said to be at the rate of 10%. Then I've got a little subtotal, ideally, less the rentals or installments, equals obviously the closing. Again and again, I'm concentrating on the word current, because as you know, once you've done your little calculation, you get the total liability. But the examiner is saying, I only want the current, please. So you've got to be a little bit careful as to which one to tick out of A, B, C, and D. So year 1, the opening, is 25 minus the deposit. So to show your good faith, the bank says, I'm giving you this plant for 5 years to use. You can keep it afterwards. But remember, because I'm giving you this 25 million worth of a check to collect the plant and take it to your premises and use it, just to show you good faith, I'd like a couple of million, please. So I feel I've got something in exchange for my check of 25 million. So the amount that's outstanding at that stage is 23 million. Okay, 1,000s. 10% thereon is 2,300. The subtotal is 25.3. The amount that's taken away is 6,000, and the closing is 19.3. %, 1930. Always do one more year to work out the current liability. So I must just explain this to you. Excuse me. This thing here is the total liability at the end of year one. Year one, of course, is this date there, 30th of September 20x5. And so if that is year one, end of, I bring it forward, and by doing one more year, I can work out the non-current liability. You see, like this. This is 21, 230. Take away the 6,000, of course. And so this is 15,230. And the gap between these two is your current liability. Which is 4070. So you always do one extra year to work out the non-current. So the 15 is a non-current liability. Okay. This one here is the non-current liability. And if that's the non-current, the current must be 40. Is that option available? It sure is. There it is. Notice the examiners offered you the 19.3 because the weaker student will think that's the current liability. Actually, that's a total liability, so slightly wrong. And the computer will just give 0 for that. Very easy indeed. And so while we're thinking about leasing, there's one more here which I can squeeze in today easily. So I'm dipping into next week's plan, but then next week we can spend a bit more time on other things. The more we do, the better. So here we are, just to conclude our session. Financial statements represent transactions in words and numbers, absolutely. To be useful, financial statements must represent faithfully, giving a true and fair view, these transactions in terms of how they are reported. Interesting, but fair. Which of the following accounting treatments would be an example of faithful representation, also known as truth and fairness, true and fair view? Seen as very, very similar. So, charging the rental payments. The rental payments, of course, includes capital. Includes capital repayments. The 6,000, of course, includes interest and capital, as we saw there. So you see, what the examiner is saying is, when you pay this 6,000, you're clearing off the interest and you're paying something towards capital, which is why the difference between these two figures must be the difference between these two figures. Because when the 6,000 is paid, you're clearing the interest and you're paying something towards capital, 3,700, which is the difference between 23 and 19.3, of course. All right, let's get back to this question. Includes capital, so that's not right. Don't like that. Not true and fair. especially where you're dealing with a finance lease. Including a convertible loan note in equity on the basis that the holders are likely to choose the equity option. I'll show you how all that works. Obviously, we've done that on the main course, but that's wrong. You can't include loan notes in equity because one day the loan note holders will convert to equity. They haven't done so yet, so you can't predict what they're going to do. So I won't accept that. Not true and fair. Treating redeemable preference shares as part of equity in the statement of financial position. Sounds terrible. Redeemable preference shares are a liability. Usually non-current liability, so I cannot accept that. Now here's another way of doing these random MCQs, or indeed any MCQs. If you look at that statement and the examiner says here's A, B, C, and D, and even as you're reading A, B, C, you can see that they're all wrong, and he says one of them is right, you could almost tick off D and say that's it. So what is D? Better check. D, recognizing factored trade receivables sold without recourse to the seller. Without recourse to the seller. So what that means quite simply is if you've got a list of receivables, let's say a list of receivables that you have on your books, in your books, what you might do is to pick out one of the big receivables. Let's say you've got 100 million there or whatever, and you've got dozens and dozens and dozens of receivables. But the biggest one is say 12 million. I'm thinking of a past exam question. Okay, so you've got on this list many receivables, but the biggest one, your biggest customer, owes you 12 million. Now, you don't want to disturb your customer, so what you could do is to sell that receivable to me, a bank, and the bank, a finance house, could give you, say, 80% of it up front. So the 12 million worth of receivables you've sold to me, and I, the bank, have given you 80% or 9.6 million up front. Immediately your cash flow improves, your liquidity. The trouble is, whose responsibility is it to collect the money from the customer? Obviously me, because I've given you 9.6 million, and thereby I've got the right to collect 12 million from your customer. Okay. Obviously, if I collect all of it, then there'll be some arrangement whereby I have to give it to you. But let's say I try to collect it, and because I have been unsuccessful, I try to come back to you to say, remember that receivable you sold me? 3 months now, I've tried, no success, and can I have that money back that I gave you? But you say to me, sorry, you sold it without recourse. In other words, I cannot come back to you as a factor or a division of the bank. Okay? So if the arrangement was, I give you the 9.6 million, and then I try to collect from your customer. If I can't collect, I haven't got any comeback to you called recourse, then of course, from your point of view, the asset should be de-recognized, removed. It's correct to do so. Correct to remove from receivables. So that has a very nice feel to it. It's de-recognized. Obviously, if there was recourse to the seller, then you won't de-recognize it. You treat it like a liability. And that, of course, is in the class notes, a chapter on substance. That's where you come across that. Okay, so I'll stop about there. We've dipped into next week's work, but don't worry, there's plenty to do. Your task, if I go back to my program, this thing over here, the biggest thing you can do, we've done a few of these random mixed questions. We've done about 4, okay? 4 done, 15th of August. I'll just put a little note in there. So we're going to start from question 5. Don't worry about those. I'll sort them out for you. But the biggest effort you can make is doing some of this homework. Okay, as I say there, if you want to pass, these are as good as essential homework exercise. One of the saddest things that's happening at the moment, especially with my students who are actually in the classroom with me, they haven't done any work. The course is all so crammed in because exams are 4 times a year, every 3 months. They simply haven't got their act together. And so when you do these questions with them, they haven't done any homework on the basics. So I'm suggesting if you can start chipping away at all of that, do that, in that sort of style. Use that as a checklist, a tick list, and make sure you do as many of those homework exercises as you can. Okay, start with the consolidations and then move on into the published accounts. The published is Quincy, Clarion, and questions like that. Otherwise, all I have to do is wish you all the best. I hope to see you. I'll be here, all being well, but I'll see you next Monday, the 22nd, when we finish the course, and on the Friday we have a mentoring session. Thank you.